One of the skills I'm glad I've learned recently has been the fact that I'm able to look at an investment idea and go, that's a really interesting idea. Seems quite attractive, but let me just hold on. Now, I don't mean just hold on indefinitely and just watch it go up or whatever, or miss the boat. But what I mean is I have a set sort of criteria. So for me, I want at least an obvious 3x. If it's not there, I don't care. It's so good it rhymes. And what that means is a lot of the time I'll see stuff where it's like, oh, I can make 2.5x off this potentially, and it looks quite attractive, but it's still not there yet. And what I've learned to do is rather than just what I think is diversifying into my 30th best idea, rather just focus on the ones that are truly great and filter out those ones and still keep an eye on them because you never know what can happen in the future. And then if something becomes attractive, then go into it and then look to build a position. And that could be because of a variety of things. The business has had a tailwind, it's grown and the valuation has been priced in. There's something which has sped up the growth a lot more than you think would have, and you've only just come to appreciate it. There's quite a few things here, but a specific example I'm looking at recently is a company called Ring Energy, and what they essentially are is a oil producer in the Midwestern Basin in America, and effectively they roll up and acquire smaller parcels of land which are producing oil, and then they apply sort of more modern fracking and other sort of methods to extract oil at better valuations and where it makes more economic sense. And this is just simply because they have experience sort of going in there, developing land and seeing opportunities that others wouldn't, or just don't care, don't have the experience, or don't want to take the risk on to do it. Whereas they've done it now on multiple projects and multiple experiences doing that. That allows them to buy land at what seems to be fair value and then sort of make it more profitable than it otherwise would. They defer payments to then increase their return because effectively the business they're buying is paying part of itself back. They do take a bit of debt on as well at 10% interest rates. Yes, it's high, but I mean it's still profitable and it still makes money at the end of the day. And looking into this business, I could see that management were really sharp. I mean, I could tell that this business model and the acquisitions they had made had worked out very well for its production, but also it had created value in a way where other sort of oil and gas producers didn't really do. I thought they were quite good and had potential to become serial acquirers and continue doing this and grow 10-15% a year, even though there are declines in their oil producing assets. I mean, just developing the opportunities themselves should probably net that out anyway. Okay, so that bit's covered. I like the business. Industry is not so great. I mean, it's quite volatile, quite cyclical, but I thought, the valuation here is pretty attractive. So when I did a conservative NPV 10 calculation, so that just means discounting cash flows by 10% a year, at this ideal price, an investor would be able to make 10% on their money consistently, assuming that oil price was fixed and no, force majeure or like random event that would throw things off would occur. And I'm just looking down on my notes here. I can see at the time, so July 2024, I could see that this business was trading at a market cap of $350 million there and thereabouts. And then if you look at the NPV 10 calculations, you can see that on an NPV 10 calculation, it was worth $855 million. And well, you can say, well, that could be based on a lot of things. There's a lot of variables in there, but one of the key ones, obviously, is the price of oil at the time. And oil had been trading at historically, I'd say, fair prices. I mean, it wasn't, you weren't coming off a massive oil spike in prices, and that had been artificially propping up the valuation. No, it was at $75 a barrel. That's generally, I'd say, historically fair. I mean, if you look back at historic prices of oil, I think a lot of people will agree with me. That's relatively in line, bang in the middle, sort of where it's historically gone. You could potentially argue a tad bit higher. So yeah, it seemed pretty good. I mean, the market cap's 350 million, 855 million NPV 10. So you could say, well, there's a 2.42x there, plus your 10% return a year, which is quite attractive there from that perspective. But I thought, I mean, it's, there still are very real risks here. The business does have a low operating cost, but there's still quite a lot of debt in the balance sheet. It's not really the greatest business model to be in. And quite frankly, I just thought there were better opportunities to be in at the time. So it was a pass for me at the time, and then still kept an eye on this business. A year later, what do you know? Oil prices have actually gone down lower. I mean, I can't believe it. Oil has been trading consistently about $65 a share, not per share, $65 a barrel consistently now. And this valuation, because obviously when you project that going forwards, your NPV is going to be completely different. So at this current oil price of $65, you have a net present value of 577 million. And sorry, these figures are all post taking off debt off the balance sheet. So you're left in like a net position, excess of debt. So assuming debt's paid off. And what this means is that your calculations are a lot more conservative than a year ago. Now, obviously, it could have done the exact opposite and run off, but that's fine because it wasn't attractive enough for me. So that I would have been completely okay with that. So what you're getting is you're getting a business which is valued at 577 million, but you know that should oil go back more towards its historic normal prices, which I don't see a reason for it not to, you would effectively be getting something at a much higher price than what it's currently showing as it's worth. But hold on, the valuation now is 170 million market cap, meaning that you can buy 577 million today if you wait a few years and discount it at 170 million. So that is a huge 3.4x discrepancy there, which is not only bigger than the initial 2.42x discrepancy, is now at 3.6 times, 3.4 to 3.6 times multiple, which is already a larger return there. So there's my 3x criteria met. But also, we're trading at very conservative oil prices. We're not the very bottom, but we're towards historic lows. I mean, bar COVID, which was an outlier in the sense that never in history have I seen another moment where oil became so worthless that people paid you for a short period of time to take oil off their hands, quite literally. Except that moment, it's very rare to see oil below $60, $55 a barrel. And if that happens, I mean, truly, we are in a great period to sort of be acquiring these assets, assuming the valuation falls in line with that. But what I'm trying to get at here is $65 a barrel is a very conservative valuation. Historically, doesn't reach that. So not only are you buying something which is worth 3.5, 3.6, 3.4 times more than it is worth today over the next few years, and you get your 10% return on top of that, it's also at very conservative numbers. Now, if I just ran that number back up to $75 a share, we're potentially talking about a 5x in terms of valuation, and that's when things can start to get really interesting, particularly as things go up and beyond that. Now, there are a few things to note that obviously the business is less profitable currently. It still has a fair amount of debt. Yes, it does have a revolving credit facility, which means it can cover its debts short term with more longer term debt, which you'll still pay off because it is still somewhat profitable. But for whatever reason, again, highly unlikely, but for whatever reason, should oil continue to trade at $50 a barrel for extended periods of time, which I do not see just because this business is already a low-cost producer in America, and you have the fact that many businesses will likely go bankrupt before this business if that were to occur. There is still some risk that, this business will struggle with its cash flows and could be worth a lot less. Not to say it'll go bankrupt, but it could just dilute itself very aggressively or something of that nature where it has to sell off its assets at pennies on the dollar. But even then, its downside protected because of the assets it holds. But what I'm trying to get to here is that now, by having the ability to say, look, this looks interesting, I can appreciate that, but unfortunately, it's not good enough for me yet. And then just watching it, keeping an eye on it, and then seeing, now there have obviously been opportunities where I've looked at them and they've gone the other way. That you look at them the next year and they're up 50, 100%. That's fine. But there are those which sort of get cheaper for whatever reason. I'll go into this one in a bit. Then they start to become really interesting to me, and that's where I think I can get outsized returns a lot of the time. and this one matches my criteria and is definitely something I'm going to be looking into pursuing further. Of course, this is my own opinion. You have to do your own calculations and whatnot. Reason for this being very undervalued is essentially large private equity shareholder who runs a fund which is now transitioning to ESG. So they're transitioning their fund from sort of dirty fuel sources such as coal, oil, to now ESG related funds. So that could be like hydro plants, solar solar powered stations. List goes on. They're going to be prioritized in terms of the fund. So what does that mean for this company? Well, it means that this large owner, which was previously owning about 30% of the company off the top of my head, has slowly been, or quite aggressively actually more recently, has been exiting its position. Now, obviously, you don't just sell 30% of the market cap overnight. What that means is that over the last 2 years, they've been quite aggressively selling the up to 30% of the daily float they've been selling by themselves. This has suppressed the stock price a lot, and even though the business has grown quite credibly, and the management team have done a pretty good job of executing actually, and kept the business balance sheet in a decent place considering where oil prices are at the minute, it's still not reflected into the stock. I mean, you've seen it even last year, trading at a P of 2-3 times its earnings, and that's with its market cap being halved now. So, on more normalized earnings, once debt is paid off, once oil prices go back to more historic averages, $75, you could easily see this business trading at 1.5 times price earnings. Now, even at current valuations, $65 a share, where the per barrel, where the business is just above break even, not just above break even, but its margins are massively narrowed. Even then, it's trading at 3-4 times earnings at cycle trough sort of levels, which to me is really exciting and a really good opportunity there. And that's sort of why it's been presented. Now, management have basically, the fund has basically, that's it, they're called Warbus Pincus. They have basically sold the majority of their stake now. I think off the top of my head from recent calculations, as of June or late May, I think they had about 10-11% of the stake left to sell. So they've sold 60-70% of their position, looking to exit the rest, obviously. That's still going to have an impact, but it's going to be a lot less over time. And I think that's when you're really going to see a huge impact, and no longer will there be anything suppressing that the valuation of the company. Again, this has come by sort of me having that skill of identifying it and then saying, well, actually, hold on, I'm going to wait. Not because I just want to wait indefinitely and miss the boat. It's because it's not attractive enough for me at the minute, but still keep an eye on it. I have like a fishing pool of compounders or businesses which I think could be worth a heck of a lot more in the future. And this was one which has stayed in there and actually they've gone, you know what, they've performed really well. I like the acquisitions they're making, the savvy capital allocators, and yet it's still trading at a huge discount, which has grown even larger since. That's why I'm interested in this position. That's what I've learned, and has also prevented me from being over diversified in lower quality ideas. Thanks for listening.